Reese, a calendar year taxpayer, uses the cash method of accounting for her sole proprietorship. In late December, she receives a $20,000 bill from her accountant for consulting services related to her small business. She can pay the $20,000 bill anytime before January 30th of next year without a penalty. Assume Reese's marginal tax rate is 30% this year, and it will be 37% next year, and she can earn an after-tax rate of 12% on her investments. Okay, so 32% this year, 37% next year, and she can earn a 12% return on her investments. So the first question is, what's the after-tax cost if she pays the $20,000 bill in December? All right, let me show you the answer. Okay, we would take the $20,000 tax deduction, right? She gets to deduct this from her business, so that's a tax deduction. She's in a 32% marginal tax rate for the current year, so 20,000 times 32% gives us 6,400. So her after-tax cost of the accounting services is 20,000 minus 6,400, or $13,600. Okay, that's the first part. Now, the second part of the question says, what's the after-tax cost if she pays the $20,000 bill in January? And they've given us a present value of a single payment at various points of return. Well, we know we're interested in 12%, okay, because they told us it's 12%. Okay, so she's got to pay this in January at 12%. So let's take a look at that answer now. Okay, so if she pays the $20,000 bill in January, she's then in a 37% marginal tax rate, and she's expecting her marginal tax rate to increase, right? So now we're talking about a $7,400 tax savings, but she doesn't have to pay the tax on this for a year. So she gets a present value of the tax savings of the $7,400 times a year's worth. So 1 year at 12%, we use a discount factor of 0.893. There's other ways you could calculate this, but we'll use the table approach to calculate the present value of the savings. Using the table approach, that's 0.893. That will give us tax savings of 6,608. So now our after-tax cost is $13,392 versus after-tax cost of $13,600. So this is a better deal. Our after-tax cost of the accounting service is less. And that takes us to the third question. It says, when should they pay it? And we've already answered that question. The $20,000 bill in January is the clear winner because we're delaying the payment for a year. It decreases the present value of the cash outflow. Okay? So there's also this minor present value benefit. By delaying her payment, she can make essentially interest on her money. Or you can think of that as the cost of capital, the benefit of having the funds available for other purposes. Okay? Hope you found this helpful.